Welcome to Financial Cake, your go-to channel for delicious financial insights. If you want to build lasting wealth, make sure to hit that subscribe button and ring the bell for notifications. Today, we're settling one of the biggest debates in the investment world. It's the ultimate asset battle, a clash of titans that has fueled conversations and family arguments for decades. In one corner, we have the stock market, represented by the mighty S&P 500 index fund. It's the champion of passive investing, the symbol of American enterprise, and a favorite for those who want to set it and forget it. In the other corner stands physical real estate. It's the tangible dream, the classic path to building a tangible legacy, and the preferred choice for hands-on investors who want to see and touch their assets. Which one is the true king of wealth building? We've crunched 50 years of data to find out. We're going deep, analyzing everything from raw returns and the impact of leverage to liquidity, the effort required, and the ever-important tax implications. By the end of this video, you'll have a clear picture of which asset class might be the right fit for your financial journey. Let's start with the main event, the returns. To make this a fair fight, we need to set some ground rules. We're looking at the historical data from 1973 to 2023, a full half-century of market cycles, booms, and busts. For the stock market, we're tracking the S&P 500. A simple investment of $10,000 in an S&P 500 index fund back in 1973, with all dividends reinvested, would have grown to an astonishing figure. Are you ready for this? That $10,000 would have blossomed into approximately $1.7 million by the end of 2023. That's an average annualized return of about 10.8%. This showcases the incredible power of compounding, where your money works for you, growing exponentially over time without you lifting a finger. Now, let's turn to real estate. Measuring real estate returns is trickier because every property is unique. However, we can use the Case-Shiller Home Price Index as a reliable benchmark for the U.S. housing market as a whole. If you had bought a property for $10,000 in 1973, based on the appreciation tracked by the index, it would be worth around $180,000 today. That's an average annualized appreciation of about 5.9%. At first glance, it looks like a knockout victory for the S&P 500. $1.7 million versus $180,000 seems like an open and shut case. But hold on, we're just getting started. Real estate has a secret weapon in its corner, leverage. Leverage is the ability to use borrowed money to invest. When you buy a house, you typically don't pay the full price in cash. You make a down payment, say 20%, and a bank finances the rest. Let's replay that 1973 scenario with leverage. Instead of buying a $10,000 property with cash, you use that $10,000 as a 20% down payment on a $50,000 property. Fast forward 50 years. That $50,000 property, appreciating at the same 5.9% annually, would now be worth approximately $900,000. You still have to pay back the original $40,000 loan, but that leaves you with an equity of $860,000. Suddenly, the gap closes significantly. Your initial $10,000 investment turned into $860,000. That's a massive improvement and brings real estate much closer to the S&P 500's performance. Leverage amplifies your gains because you're benefiting from the appreciation of the entire property value, not just your down payment. But this comparison still isn't complete. A house isn't just a number on an index, it can also generate income through rent. This is where real estate truly begins to shine and challenge the stock market's dominance. Let's add rental income to our leveraged real estate scenario. A common rule of thumb is the 1% rule, where a property can generate monthly rent equal to 1% of its purchase price. For our $50,000 property, that would be $500 per month or $6,000 per year. Of course, being a landlord isn't free. You have expenses, property taxes, insurance, maintenance, repairs, and periods of vacancy. A conservative estimate for these costs is around 50% of the rental income. So, after expenses, our property generates about $3,000 in positive cash flow per year. Over 50 years, assuming you reinvest this cash flow back into your S&P 500 fund to keep things comparable, the numbers get very interesting. When you factor in the property's appreciation to $900,000 and the compounded growth of that reinvested rental income, the total value of the real estate investment now rivals, and in many historical periods, can even surpass the S&P 500's $1.7 million. The final figure depends heavily on rent growth and your ability to manage expenses efficiently. This brings us to our second major point: effort and involvement. Investing in an S&P 500 index fund is the definition of passive. You buy the fund, and that's pretty much it. You can check on it once a year or even less. It requires minimal effort, no expertise, and no late-night phone calls. Real estate, on the other hand, is a part-time job. It's an active investment. You have to find the right property, secure financing, and then manage it. You become a landlord, which means dealing with tenants, fixing leaky faucets at 2 a.m., and handling vacancies. You can hire a property manager, but that will eat into your profits, typically costing 8 to 12% of your rental income. Real estate requires work, knowledge, and a significant time commitment. Next up, let's talk about liquidity. This is a huge advantage for the stock market. Liquidity refers to how quickly you can convert an asset into cash without affecting its market price. With an S&P 500 fund, you can sell your shares and have cash in your bank account within a few business days. The process is fast, easy, and has very low transaction costs. This flexibility is crucial if you need to access your money for an emergency or a new opportunity. Physical real estate is the opposite. It is one of the most illiquid assets you can own. Selling a property is a long and expensive process. You have to find a real estate agent, list the property, show it to potential buyers, negotiate offers, go through inspections and appraisals, and finally close the sale. This can take months, and the transaction costs, including agent commissions and closing fees, can easily eat up 6 to 10% of the sale price. Finally, we need to consider the tax man, because it's not what you make, it's what you keep. Both asset classes offer significant tax advantages, but they are very different. With stocks, your primary tax advantage is related to long-term capital gains. If you hold your S&P 500 fund for more than a year, your profits are taxed at a lower long-term capital gains rate, which is significantly less than ordinary income tax rates. Real estate offers a whole suite of tax benefits that can be incredibly powerful. First, you can deduct many of your expenses, including mortgage interest, property taxes, insurance, and repair costs, from your rental income. This reduces your taxable income. Even better is the concept of depreciation. The government allows you to deduct a portion of your property's value from your taxable income each year to account for wear and tear, even if the property is actually appreciating in value. This is a phantom expense that can dramatically lower or even eliminate your tax bill on rental income. Furthermore, when you sell a property, you can use a 1031 exchange to defer paying capital gains taxes. This allows you to roll the proceeds from the sale of one investment property into the purchase of another, letting your investment grow tax-deferred indefinitely. So, who is the winner? After 50 years of data, the truth is that there is no single champion for everyone. The S&P 500 and real estate are both phenomenal wealth-building tools, but they cater to different types of investors. The S&P 500 is the undisputed king of passive investing. If you want a simple, hands-off way to build wealth with excellent returns and high liquidity, it's almost impossible to beat. It's perfect for the investor who values time and simplicity above all else. Real estate is the champion for the active, entrepreneurial investor. If you are willing to put in the work, manage tenants, and deal with the complexities of property ownership, real estate offers incredible advantages through leverage, cash flow, and unique tax benefits. It can deliver returns that meet or even exceed the stock market, but it demands your time and attention. The ultimate strategy might not be choosing one over the other, but understanding how both can fit into a diversified portfolio. You could use an S&P 500 fund as your core, passive growth engine, while selectively adding real estate for income and tax advantages. It all comes down to your personal goals, your risk tolerance, and how much time and effort you're willing to commit to managing your investments. Are you a passive admiral of a fleet of stocks, or a hands-on captain of a tangible property? The best investment is the one that you understand and can stick with for the long haul. Both the S&P 500 and real estate have proven their ability to create immense wealth over the last 50 years. The choice is yours. What do you think? Let me know in the comments below which asset class you prefer and why. And don't forget to like this video and subscribe to Financial Cake for more deep dives into building your wealth. Thanks for watching, and we'll see you in the next video.